Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, number 36. What are asset classes? Before we kick off with it all, there's the disclaimer: facts, it's figures, it's information, it's not advice. Yep, in the previous episode, we were talking about, what is a share? And when people think about investing, they sort of think, oh yeah, we've got to invest in shares. But there are certainly a lot of other things as opposed to just investing in shares. And so we've got to get a head across all the jargon, the terminology of what's out there before we start thinking about how we're going to create our investment portfolio. So, yep, yesterday we talked about shares. Some people call them stocks. Quite often you might hear them be called equities. Pretty much all the same sort of thing. People are thinking about owning a share in a company like CBA, that's Commonwealth Bank, Rio, and of course WOW, that's Woolworths. So all these stocks in Australia generally have a three-letter code, which we'll go through when we talk about actually buying these things. Now, indices we're going to go into a lot because indices are becoming a very, very, very popular way of getting into the market, but without taking on the risk of just buying Commonwealth Bank. I mean, I'm not saying there's anything wrong with Commonwealth Bank, but if you're going to buy, would you buy Commonwealth Bank? Would you buy NAB? Would you buy ANZ? Or would you buy Westpac? How do you know which bank to buy? And so you can indeed buy the whole market. Should you indeed be buying banks? Should you indeed be buying the mining companies or some retailers or whatever goes on? So where do you start is always one of the biggest problems when we're getting into investing. So indices are basically the market. So you can see these little letters after this market indices there. ASX 200. What that means is that's the top 200 companies in Australia as they appear in their capitalisation, as we talked about. And so you can actually buy an ASX 200. So you can actually purchase for $500 or $1,000. You can, whatever you want to start off with, you can actually put your money out there and buy this index. And effectively what you've done is you've bought all of the top 200 companies in the ratio that they exist. Now, you haven't got a full share of everything, obviously, with only $1,000, but you've got a portion. And so, but it means that if the market, and if you're listening to Alan Kohler on the ABC News at night time, he just said the market went up by 0.8% today. Well, then if you've bought that index of the Australian market, then yes, your money would go up by pretty close to 0.8. But of course, it's not just the Australian market you can buy these days. That FTSE, the FTSE, that's effectively the top 100 companies in the UK. The S&P 500, the top 500 companies in the US. But there's basically every single country has an index, and of course we've got more than one. So with the ASX 200, there's also an ASX 20, so it's just the top 20 companies, and there's the top 50 and the top 500, and so it goes on. So there's all these different ways of looking at the market, whether we're looking at just the big blue chips, are we looking at the overall market, and so forth. But we're going to go into those things in a lot more detail because it is quite a sensible way when we're starting out to sort of spread our money across a lot of different shares rather than focusing on any one particular company. And the same thing is with market sectors. So yes, I say if you wanted to buy, a bank, do you know which one to buy? Well, you could actually buy a market sector. You could buy the financial sector, effectively buying all of the financial companies, the banks and so forth. You could buy the mining sector. So you've bought all of the mining companies in the ratio that they exist. So obviously in your sector, there'd be a big chunk of it would be BHP and Rio, the big ones, Fortescue and so forth. And there'd be, to a lesser degree, some of the smaller little speculative mining companies as well. And of course, the retailers, you've got your Harvey Normans and your JB Hi-Fis. And so you're effectively buying a chunk of the stocks and shares that are literally just in the retail sector. And there's a whole swag of these different sectors, technology and utilities and so forth. So it's, again, you might believe that I've got a bit of spare money. I really believe that, and you might have your own perception of what might go up. Could be health, the fact that people are all getting older, in which case there might be a big demand on health stocks, and so it goes on. So it's just a way of you can sort of focus if you want to focus, or if you go to the indexes, you can just get a much more broad investment. Now, commodities is basically anything like gold, oil, wheat, orange juice, pork bellies, you name it, anything that is sold as a commodity. And I say it just covers all the different grains and all the different produce, and so it goes on. And you can actually buy those things as they go up in value and down in value. And of course, those things tend to be a little bit seasonal. Obviously, that like things like heating oil, that's one of the things you could buy. Might change in price during the American winter or something like that. But people make money out of buying and selling these things like gold and oil and wheat and so forth. Currencies, yep, we're looking at the difference between, with currencies, you don't just buy a currency. What you're doing is you're buying the difference between two currencies. So you buy the difference between what the Australian dollar is compared to the US dollar. It's got to be some sort of comparison. So it could be the Australian dollar to the English pound, or the pound against the dollar, and so it goes on. I'm not suggesting for a second you start off with these things. I'm just sort of explaining at this point in time that we will over time broaden your outlook, and having an understanding of these other things as well can really help us to diversify our portfolio. So we're not just concentrating on stocks and shares, because at some point it may not be a sensible thing to be doing in actually buying shares if shares are going to struggle, but things like gold might indeed be going up, or whatever it may be. And of course, this one at the bottom, exchange traded fund, is literally it's just a method of buying these things above. So you can get an exchange traded fund that buys stocks, a exchange traded fund that looks at indices and sectors. There's exchange traded funds on commodities and so forth. If anyone's read The Barefoot Investor, probably one of the most popular finance books available until mine comes out. But it's a very popular book. He loves ETFs. Look, I tend to agree with him. They're a very, very useful way of investing our money. Nice and simple, nice and easy, and we can get a really good, broad approach to our investing. But we'll go through all of these things pretty much one by one over our future sessions. Now, of course, when you look at perhaps your super fund, and if you've ever looked at it closely, some of the super funds will actually generate a pie chart of where your money's invested. Now, it won't tell you that you've got a certain amount in Commonwealth Bank or a certain amount in whatever. They break it up into what's called asset classes, the different types of assets that are indeed available. So we were talking about our shares and so forth, but the sort of the common ones that when you look at your, say, especially on your super statement, if your super statement does indeed show it, they'll break it up into these things like shares, bonds, property, and so forth. And so, and each one of those has got a different consideration. So within our shares, yes, it could be Australian shares, and of course it could be international shares. Now, there may be a certain time when buying Australian shares makes a hell of a lot of sense, but other times we'd be better off having more in international shares. And you've only got to look what happened to the American market, for instance, during COVID. The amount that it grew by was just, it blew Australia out of the water as far as the growth is concerned. And but yeah, at what point is it going to be good to be investing in Australia rather than perhaps international? Emerging markets, so these are countries that have struggled in the past, but now starting to get in touch with the real world and developing. And of course, those sort of markets can all of a sudden really take off, and there's some good money to be made. But also, it's far more risky if we're investing in sort of countries that are a bit of an unknown there. And of course, ethical, sustainable. So all of these things are different. They're all still shares in companies, but we're sort of targeting a different niche of what type of shares you're really looking at there. Now, we're going to go into bonds and so forth later on, but bonds, basically, you can get a government bond, a corporate bond. All a bond is effectively it's a debt. So with a bond, you effectively lend the government some money. So you might give them $50,000. They give you a return on your money, and they say, we'll give you 3%, 4%, and so forth, whatever it may be, on your bond. You get the money back at the end of the bond period. So it might be 3 years, 5 years, 10 years, 30 years. Some countries even have a 100-year bond. So you get this interest rate that's sort of locked in over the period. You want to make sure the interest rate was correct if you're locking yourself in for that length of time. But there are shorter term bonds, corporate bonds, where you're doing exactly the same thing. You might get a bond from, say, Commonwealth Bank, in which case you're lending Commonwealth banks to go off and do something with the money, but they're guaranteeing to pay you that money back. And of course, if the company goes broke, you're going to get your money back. And I suppose literally the same thing with the government. But generally speaking, pretty safer way, because you know your return that you're going to get on the money, and you basically get your money back at the end of the period. Infrastructure is an interesting one, where we're looking to invest our money in things like airports, tollways, and shipping ports, old age homes, things that sort of tend to make money irrespective really of what's going on. You've all got to, well, I suppose during COVID, airports were certainly slowed down, and so did tollways. But generally speaking, even if the share market is going through a bit of a struggle, people are still in old age homes and probably still flying around. So it's just you're spending money into buying shares in companies that are focusing on that infrastructure. And I'd say at times it can be quite a useful sort of a thought pattern there. Now, property. We all know property. Now, it's got their direct and listed. Direct property means you actually own the building. You've actually put your money and your part share, perhaps, or you own it all, or you got a part share in it, whatever it is. But it actually is a building that is owned. And there's a lot of super funds, obviously, with the amount of money they've got. They might be owning huge, big office blocks in Melbourne and Sydney and so forth. And that sort of makes it quite good for the super fund, in the regard that if they own the building themselves, then they've sort of eliminated the middleman and can make quite a good return on their money, even when, let's say, the share market is playing up. So they can get some quite decent returns from a conservative portfolio, because the money's just sort of being generated, and there's not the issues of having to go to some sort of investment manager. But a listed property is literally like buying shares in property. And so there's a lot of listed funds and so forth out there, where you put your money in, and effectively you've got a part share in, it might be hundreds of different properties. It might be shopping centres, it might be office buildings, it might be warehouses and so forth. But again, property might be moving in a totally different way than our shares or our bonds or whatever the case may be. Cash is obviously, money in the bank. Could be sort of like, a 90-day term deposit type of money. But it's generally speaking, obviously, can be a good place to go when the world's going crazy. Low returns, generally speaking, but obviously with interest rates going up, cash is starting to be a little bit more useful to us, in the regard that we're finally starting to get some decent returns. But here they are already. There's a bank talking about, everyone else seems to be talking about it, not necessarily the Reserve Bank, that interest rates will go down later in the year. Well, we're interesting to see whether it does or not. And of course, there's all these other things. Alternative hedging is literally taking a position so that, like the Australian dollar compared to the other, if you're buying something in America, that you're going to actually lock it in with the Australian dollar and so forth. But there's heaps of other things there that we won't worry about those at the time. But just understand there's all sorts of other oddball things that your share person, your fund manager, your investment manager and so forth will be investing in. And we'll cover across all the jargon, the more complicated ones, a little bit later on. Now, I don't expect you to be able to see all the details in this slide. But what I'm trying to prove here is, you can see down the left-hand side there that what we've got are the different asset classes. So we've got these Australian shares, international shares, and so forth. And each row there is a different colour to represent the different returns and so forth on those different asset classes. So you've got an average returns and minimums and maximums and so forth. But the big chart on the right-hand side is basically showing years and showing the performance of these asset classes from the best performing number 1 down to number 8 there. But you can see it just looks like a crocheted mat. You know, there's no sort of pattern to it as such. It's just the fact that at times these asset classes seem to take it in turns at being number 1. Things go in cycles. So at some point, you know, cash is the best place to be, shares are the best place to be, and so it goes on. So it's a case of, do we know that in the future? Of course not. Of course not. If you do, let me know, and I'll, you know, you can come into my place and we'll have a bit of a chat. But it just gives you the idea that having a bit of everything, people say, why would I have my money in, you know, in cash or in bonds or so forth, when, you know, shares have been making the most amount of money? But there are going to be times where shares are going to be losing. And so if we can have some money in some of these other things, we're sort of ironing out some of the dramas. Now, some people are quite happy to take on, you know, they go jump in, boots and all, and they just sit there and cope with the markets going up and down like a yo-yo. Over time, they'll be rewarded for their patience and their gumption. But many of us wouldn't be able to cope if we saw our money going backwards by about 40% or so. So just an interesting little idea, which is going to lead us into what we're going to be talking in future sessions about, you know, spreading our money a bit to try and even out the risk, making us more prepared to hang in there when things are sort of not going ideally to plan. Okay, we're here to help you understand some of this as time goes on, but we'll join you in another session.